everyone. Today we will start with a new chapter. We will discuss the stages of audit planning. As mentioned previously, there are three stages of the audit process. The first stage is to plan the audit. The second stage is to perform audit procedures in order to accumulate sufficient appropriate evidence, helping the auditor to form a conclusion and to express an opinion on the financial statements. To determine whether the financial statements are fairly stated in accordance with the set of accounting standards adopted, whether the financial statements present fairly in all material respects the financial position of the firm, its results of operations and cash flows in accordance with accounting standards generally accepted, and whether the financial statements are free of material misstatements that are likely to mislead users' decision-making process. And the final stage is to issue audit report, communicating the auditor's findings to interested users and expressing an opinion on the financial statements under audit. We have already covered in this course the second and the third stage. We have explained the several audit procedures and tests and how they are used in order to accumulate sufficient appropriate evidence in order to support various audit assertions, whether transaction related audit assertions or account balance related audit assertions. We have also explained in details this third stage, the issuance of the audit report, the uniform wording of the audit report and its supports, the several types of audit reports, the standard unqualified audit report, the unqualified audit report with explanatory paragraph or modified wording, and the departures from the unqualified audit report, including qualified audit report, adverse of opinion audit report, and disclaimer of opinion audit report. Today we will explain the first stage in the audit process that comes before the performance of audit procedures and accumulation of sufficient appropriate evidence. The first stage is to plan the audit. So the first stage in the audit process is audit planning, and this is the subject of interest today. The first question that we need to answer is why audit planning is essential. Why the auditor should plan for audit engagements before starting in conducting audit procedures and tests and accumulating evidence. Audit planning enables auditor to obtain sufficient evidence and hence help the auditor to minimize legal liability. Audit planning helps to keep audit costs reasonable. It also helps the CPA firm to remain competitive. It helps to avoid misunderstanding with the client, and it is necessary for good client relations. It facilitates high-quality work. It helps the auditor to maintain a good reputation in the business community. What are the major steps in audit planning? The first step is to assess acceptable audit risk and inherent risk. The second step is to accept a client and perform initial audit planning. The third step is to understand the client's business and the industry. The fourth step is to assess client's business risk. And finally, to perform introductory and analytical procedures. Assessing acceptable audit risk and inherent risk is an important part of audit planning because it helps to determine the amount of evidence that will be accumulated, the experience level of staff assigned to the engagement, and the cost of audit process, which will be reflected in audit fees. For instance, if inherent risk for inventory is high because of complex evaluation issues, more evidence will be accumulated in the audit of inventory. More experienced staff will be assigned to perform testing in this area. Thus, the cost of audit will be high, which will be reflected in audit fees. Audit fees will be relatively high in this case. So again, if inherent risk for inventory is high because of complex evaluation issues, more audit procedures should be performed in order to accumulate more evidence in the audit of the inventory account. The auditor should rely on more experienced staff to perform testing in this area. At the end of the day, the cost of the audit will be higher, and the audit fees required from the client will be relatively high. So, audit risk, including acceptable audit risk and inherent risk, influence the conduct and cost of financial statements audit. So, what is acceptable audit risk and how it affects the financial statement audits at its cost? Acceptable audit risk is a measure of how willing the auditor is to accept that financial statements may be materially misstated after the audit is completed and unqualified opinion is issued. When auditors decide on lower acceptable audit risk, they want to be more certain that financial statements are not materially misstated. Therefore, they will accumulate more evidence, and hence audit cost will be higher, which will be reflected in higher audit fees. Zero risk is certainty, and 100% acceptable audit risk is complete uncertainty. Audit assurance is a complement of acceptable audit risk. That is 1 minus acceptable audit risk. For instance, if acceptable audit risk is 5%, the audit assurance will be 95%. So acceptable audit risk is a measure of how willing the auditor is to accept that financial statements may be materially misstated, will be found materially misstated after the audit process is completed and unqualified audit report is issued and communicated to interested users. The lower the acceptable audit risk, the better. The lower the acceptable audit risk means low acceptable audit risk means that the auditor will not accept to find that financial statements is materially misstated after the audit process is completed and unqualified audit report is issued and communicated to interested users. This means that the auditor will accumulate more evidence in order to ensure that financial statements are free of material misstatements. Audit assurance is another term that can be used. It is a complement of acceptable audit risk. If acceptable audit risk is 5%, for instance, audit assurance provided that financial statements are free of material misstatements is 95%. What is inherent risk and how it affects financial statement audit and its cost? Inherent risk is the risk that financial statements will include material misstatements due to a factor other than the failure of the client's internal control system. So the client has effective internal control system, and despite of having such effective internal control system, there is a possibility that financial statements will include material misstatements. Inherent risk level is relatively high when transactions are complex. For instance, during the 2008 financial crisis, it was difficult for even most intelligent financial professionals to understand asset backup securities and related transactions. So inherent risk level was very high during this era. Complexity of transactions increases inherent risk. Inherent risk level is also relatively high when a high degree of subjectivity, high degree of judgment is required in regard to financial estimates. And this is a case in general with respect to accounts receivable. There is high degree of subjectivity required to estimate amounts of uncollectible amounts and to determine bad debt reserves. If the auditor concludes that there is high degree of likelihood of material misstatements in accounts receivable due to changing economic conditions, the auditor concludes that inherent risk for accounts receivable is high. Inherent risk level is also relatively high for specific industries. For instance, for merchandising companies, the inherent risk is high for inventory accounts. For companies operating in highly regulated sectors such as financial sector, insurance companies, banks, financial institutions, inherent risk is very high for these sectors. When level of inherent risk is high, the auditor should take steps to improve audit procedures, to perform more audit tests, to increase sample size, for instance, so audit evidence accumulated will be increased, and audit cost accordingly will be higher, which will be reflected in higher audit fees required by the auditor. So the first stage in audit planning is to assess audit risk, including acceptable audit risk and inherent risk. The second step is to accept the client and perform initial audit planning. So after assessing audit risk, the client decide whether to accept a new client or continue serving an existing one. At this stage, the auditor identifies why the client needs an audit and obtain an agreement or understanding with the client about terms of engagement, and develops an overall audit strategy, including engagement, staffing, and deciding whether the auditor will rely on the opinion of specialists. Why a CPA firm must use care in deciding whether to accept a new client or even to continue to serve an existing one? Because the auditor has legal and professional responsibility not to accept the clients who lack integrity. Fees received by the auditor can cause more problems than they worth in effect. That's why some CPA firms now refuse clients operating in high-risk industries such as information technology companies and financial institutions, including insurance companies. Having financial statements, including material misstatements, published and communicated to interested users, along with unqualified audit report stating that the financial statements are free of material misstatements and to represent fairly the financial position of the firm, its results of operations and cash flows, is problematic because it will mislead the user's decision-making process. That's why the auditor has legal and the professional responsibility not to accept the client who lack integrity, clients who are likely to manage earnings, manipulate earnings, or even to have fraudulent financial reporting. Before accepting a new client, the auditor should investigate CPE industry knowledge, whether the auditor has knowledge related to the client's industry, the client's standing in the business community and its reputation, the client's financial stability, whether the client is financially stable, generating profits over time, no losses, no failures or bankruptcies or so. The client's relation with previous CPA firms, whether the client has a good relationship with previous auditors, having no problems with previous auditors and so. And the auditor can obtain such information from previous auditors, banks the client is dealing with, firms that has business with the client, and so on. So the auditor should decide whether to accept a new client and should also decide whether to continue to serve an existing one. Many CPA firms evaluate existing clients annually to determine whether there are reasons for not continuing to do the audit for such clients. reasons may be previous conflicts over the appropriate scope of the audit or the type of opinion to issue, unpaid audit fees, the client lack of integrity or high audit risk. After accepting the client, the auditor should identify the client's reasons for audit. The auditor gets information about why the client is having an audit and who are the likely users of financial statements. The auditor has to accumulate more evidence when financial statements are to be used extensively, such as in case of firms listed in the stock market and companies that are to be sold in the near future. The most likely uses of financial statements can be determined from previous experience with the client and discussion with management. Auditing standards require that auditor document their agreement with the client in an engagement letter. Engagement letter include engagement objectives, responsibilities of the auditor and management. Normally, management is responsible to prepare financial statements in accordance with GAAP, choose the accounting standards, appropriate accounting standards, and make judgments and estimates and disclosures in applying those standards. And it is the auditor's responsibility to express an opinion on the financial statements based on an audit. This is mentioned in the engagement letter. Identification of the financial reporting framework used by Board of Directors, whether the Board of Directors adopt GAAP or IFRS. Prior to 2005, for instance, choosing whether to adopt local GAAP or IFRS was voluntary, not mandatory, in some EU countries like Germany. So when choosing which set of accounting standards to adopt is voluntary, is optional, the engagement letter should include which set of accounting standards is adopted. However, after 2005, it became mandatory in EU countries to adopt IFRS. Preference to the expected form and the content of the audit report. What is the expected format and the content of the audit report? The engagement limitations related to timing, time limits of the audit process, branches or subsidiaries that will be subject to audit, and so on. Agreement to provide other services such as tax returns and management consulting. Some auditors provide non-audit services to clients along with the audit service, such as tax returns, preparation of tax returns, and other management consultation. Agreement on fees, audit fees should be mentioned in the engagement letter, and a statement that the auditor can't guarantee that all acts of fraud will be discovered to reduce legal responsibility. This is mentioned in the audit report in order to reduce the auditor's legal responsibility. So the auditor assesses acceptable audit risk and inherent risk before deciding whether to accept the client or not. Then the auditor makes the decision whether to accept the client, a new client, or to continue serving an existing one. After this, the auditor performs initial audit planning, identifying why the client needs the audit, and obtain an agreement with the client about the terms of the engagement, which is expressed in the engagement letter. After this, the auditor develops overall audit strategy, including engagement staffing and deciding whether the auditor will rely on the opinion of audit specialists. Selecting staff for engagement is the responsibility of the CPA firm. The certified public accounting firm is responsible to select competent and qualified staff for the engagement. Staff assigned must be knowledgeable about the client's industry, must be competent and qualified to understand the set of accounting standards adopted and the amount and the nature of evidence need to be accumulated. The auditor considers the nature of the client's business and the industry, including the areas where there is greater risk of significant misstatements, to determine resources required for the engagement, including engagement staffing. The auditor should also decide whether he will need to rely on the opinion of outside specialists in technical areas as statistical sampling, business evaluation, and computer risk. In case of relying on the specialist's opinion, the auditor has responsibility to assess the specialist qualifications and has responsibility to review his work. He should also consider the specialist's relationship with the client, and if there is a relationship that can impair the specialist objectivity, whether the specialist opinion will be biased in favor of the client if there is close relationship between the specialist and the client. In this context, the specialist should be independent from the client to ensure the objectivity of his opinion. The auditor should not refer to a specialist in the audit report unless the specialist's report results in departure from unqualified opinion. So if adverse opinion or disclaimer of opinion or even qualified opinion is issued by the auditor because of the opinion of the specialist, the auditor need to refer to the specialist in the audit report. Otherwise, he will not refer to the specialist in his report. In this session, we have explained the first two steps in the audit planning process: assessing acceptable audit risk and inherent risk, and accepting a client and performing initial audit planning. The next time, inshallah, we will complete the other steps: understanding the client's business and industry, assessing client's business risk, and finally performing introductory analytical procedures. Thank you.